Dear viewers, I hope you liked my previous lecture. Today we're going to talk about the business cycle. The term business cycle or economic cycle or boom bust cycle refers to economy-wide fluctuations in production, trade, and general economic activity. From a conceptual perspective, the business cycle is the upward and downward movements of the levels of GDP and refers to the period of expansion and contractions in the level of economic activities like business fluctuations around a long-term growth trend. A business cycle is completed when it goes through a single boom and a single contraction in sequence. The time period to complete the sequence is called the length of the business cycle. A boom is characterized by a period of rapid economic growth, where a period of relatively stagnated economic growth is a recession. These are measured in terms of the growth of real GDP, which is inflation adjusted. If we look at the diagram that is given, the straight line in the middle is the steady growth line. The business cycle moves about the line. In other words, we can call it the trend line. And what is trend line? Trend line is actually the line that growth would follow if all its factors of production are fully employed over a period of time. The stages of the business cycle are expansion, peak, recession, depression, trough, recovery. The first stage in the business cycle is expansion. In this stage, there is an increase in positive economic indicators such as employment, income, output, wages, profits, demand and supply of goods and services. Debtors are generally paying their debts on time, the velocity of money supply is high, and investment is high. This process continues as long as economic conditions are favorable for expansion. The economy then reaches a saturation point or peak, which is the second stage of the business cycle. The maximum limit of growth is attained. The economic indicators do not grow further and are at their highest. Prices are at their peak. This stage marks the reversal point in the trend of economic growth. Consumers tend to restructure their budgets at this point. The recession is the stage that follows the peak phase. The demand for goods and services starts declining rapidly and steadily in this phase. Producers do not notice the decrease in demand instantly and go on producing, which creates a situation of excess supply in the market. Prices tend to fall. All positive economic indicators such as income, output, wages, etc. consequently start to fall. There is a commensurate rise in unemployment. The growth in the economy continues to decline, and as this falls below the steady growth line or the potential level of the economy, the stage is called depression. In the depression stage, the economy's growth rate becomes negative. There is further decline until the prices of factors as well as the demand and supply of goods and services reach their lowest point. The economy eventually reaches the trough. It is the negative saturation point for an economy. There is extensive depletion of national income and expenditure in this phase. After this stage, the economy comes to the stage of recovery. In this phase, there is a turnaround from the trough and the economy starts recovering from the negative growth rate. Demand starts to pick up due to the lowest prices, and consequently supply starts reacting too. The economy develops a positive attitude towards investment and employment, and production starts increasing. Employment begins to rise, and due to accumulated cash balances with the bankers, lending also shows positive signals. In this phase, depreciated capital is replaced by producers, leading to new investments in the production process. Recovery continues until the economy returns to steady growth levels. It completes one full business cycle of boom and contraction. The extreme points are the peak and the trough. In the diagram, you can also see positive output gap and negative output gap. Now, what exactly do we mean by output gap or GDP gap? It is actually the difference between the actual output being produced in the economy and the potential output that the economy can produce given its resources are fully employed. What is positive GDP gap? When an economy is producing more than full employment output, when there is a positive output gap, the rate of unemployment is less than the natural rate of unemployment, and economy is operating outside of its production possibility curve. What is negative GDP gap? The difference between actual output and potential output when an economy is producing less than full employment output, where there is a negative output gap, and in negative output gap the rate of unemployment is greater than the natural rate of unemployment, and economy is operating inside its production possibility curve. So negative GDP gap is going to take place when there is recession, depression, troughs in the economy, and positive output gap is going to take place when there is the economy has peak or boom.